There is the 22nd of April 2025 about cash flow, free cash flow. Free cash flow you can calculate by revenue minus cost minus depreciation with 1 minus tax rate plus depreciation minus capital expense minus change of net working in capitals. You can ask why minus net working in capital because if you can receive money directly, then there will be no networking in capital. But if there's networking in capital happens, which means you should receive money, but you didn't receive money, so you should minus it when you calculate in free cash flow, because the concept of free cash flow is really free money that you can actually use. And there was also problem that was calculating using continuously growing perpetuity, which is formula which is C over interest rate minus growth rate. I thought it is how it is different with perpetuity, sum of perpetuity formula, which is some series, sum of 1 plus AR squared plus dot dot dot. The two difference is one is growth rate is changing, and the second thing is except the thing that making it present value, the big changes was there was the growth rate is different. Yeah, also there will be in annuity, there will be same problem exist. And the break-even point, and for tax loss carry forward is there was loss happen because loss happen, we can reduce the taxable income, and tax loss carry backward is when refund of tax, which I already there's refund of tax which I already paid in the past. This is tax loss. And when we do adjustment of cash flow, we need to think about liquidation and salvage value at the end. And for NPV, the first graph is only two parameter changes in NPV. So price and volume combinations for equivalent NPV, only two parameters are changed in this. And if there are a lot of parameter changes, then it will be like huge, messy, 3 or 4 dimension or 5 dimension, multi-dimension. And also second graph is best and worst case parameter assumption. This is only show a little bit simplified version of multi-parameter cases, only the NPV of the worst case and best case and worst case parameter assumption. So in the book, uh, what book is showing is just sales cost of goods and calculating unlevered net income. It seems like same as net income in income statement formula, but in this book, it's just very simplified. Original unlevered net income definition is there should be uh, not no liability, but in this situation, we just really simplified it. We really simplified it. And when we're calculating free cash flow, what we are doing is basically plus depreciation minus capital expenditures and minus increase in net working capital. Like I said before. And this is tax loss carry forward situation. Like in this book, if you see here that there is 140 million loss happens, then what they are doing is dividing the loss to 5 years to reduce the taxable income. And yeah, so unlevered income, net income, basically you can think of calculating it by EBIT multiplied by 1 minus tax rate. Um, and there was also problem that we should calculate the opportunity cost, like 8.6, we should calculate opportunity cost first. When you calculate opportunity cost, what we should consider is like could be sold is 2 million, but we should also minus the 20% multiplied by 2 minus 1 million, because 20% is probably it should be some kind of tax rate or stuff. And 2 million minus 1 million is also resale value of 2 million minus book value of 1 million. So when you calculate opportunity cost, you should also opportunity cost calculation. You also need some tax rate with tax rate and book value, book tax rate, resale value on book value is what you should calculate together. Thank you for today. Thank you very much today.